Warren Buffett is out, and $373 billion in cash is in. Welcome to this deep dive explainer on the absolute monumental structural shift happening right now at Berkshire Hathaway. I mean, think about it. If the world's greatest investor is flat out refusing to buy this market, we really have to stop and ask, why are you? Today, we're going to unpack the data, the heavy math, and the underlying philosophy driving the world's most successful investment conglomerate as it enters a completely brand new chapter.
So let's dive right into this crazy paradox. Right now, in the spring of 2026, the S&P 500 is surging. We're seeing a market that's just fueled by extreme AI euphoria, relentless retail momentum, and honestly, an overwhelming fear of missing out. Yet, the most successful capital allocation machine in history is essentially shorting this entire rally by hoarding liquidity. They're just not participating. They aren't chasing the momentum. The big overarching question we have to answer today is why a firm literally built on buying great businesses is suddenly choosing to buy absolutely nothing. $373.3 billion. Just let the sheer gravity of that number sink in for a second. That is Berkshire's Q1 2026 cash pile. Look, this isn't just a simple rainy day fund, and it's definitely not some temporary holding position. We are talking about the largest liquidity reserve held by any non-banking corporation in recorded history. It's literally larger than the gross domestic product of many developed nations. To truly understand the market right now, we have to recognize that a cash pile of this magnitude isn't normal corporate behavior. It's a structural anomaly that fundamentally changes how we need to think about capital allocation today. Here is our roadmap for this explainer. We're going to cover 1. The $373 billion mystery. 2. Cash as a call option. 3. The equity risk premium. 4. Abel's operational alpha. And 5. The FOMO versus the fortress. All right, kicking things off with Section 1, the $373 billion mystery, looking at scale and the short-form pivot. To really wrap our heads around the why, we first need to contextualize the absolute staggering magnitude of this record-breaking liquidity. It brilliantly illustrates the insane firepower the new CEO, Greg Abel, has right at his fingertips. He isn't just avoiding buying a mid-sized company here or there. The math is wild. He could literally walk into the boardroom of Walt Disney, Uber, or Airbnb and buy the entire company in cold, hard cash today, without taking out a single bank loan. In fact, if he bought Disney outright, he would still have over $190 billion left over in the checking account. He has the capital to swallow foundational pillars of the modern economy in a single afternoon. Yet despite this immense capacity to absorb entire global industries, he actively chooses 0% business growth. He is intentionally staying as far away from the bidding table as possible. Moving right along to Section 2, cash as a call option, and how yields look in the 2026 macro environment. This is where the macroeconomic environment of 2026 completely changes all the rules. With the 10-year Treasury yield sitting strong at 4.39%, the opportunity cost of remaining on the sidelines has basically vanished. Under Greg Abel, cash is being managed as an expirationless call option on future market distress. Think about how a regular call option works, right? You pay a premium for the right to buy an asset at a specific price, and you are racing against a ticking clock before it expires. But Berkshire's cash pile flips that whole dynamic upside down. Because short-term T-bills are pumping billions in interest income into Berkshire every single quarter, they're essentially getting paid billions of dollars to wait for a market crash. There is absolutely no time limit. Any new business acquisition doesn't just have to be good, it has to mathematically clear this 4.39% risk-free hurdle, plus account for all the operational headaches of actually running a company. Which brings us to Section 3, the equity risk premium, exploring a massive mathematical disconnect. You see, Berkshire Hathaway isn't just guessing that a market trading at 25x multiples is overvalued. They are calculating it rigorously. And to understand their calculation, we first need to define the equity risk premium, or ERP. This is the foundational metric that's driving their highly defensive posture right now. Think of it as hazard pay. If you're going to leave the absolute guaranteed safety of a government bond, you need to be compensated for stepping out onto the incredibly volatile tightrope of the stock market. You simply need extra yield to make the risk worthwhile. Let's walk through the math step by step so you can see exactly what Berkshire sees, because this is where the market logic just totally breaks down. Step 1, you take the forward earnings yield of the S&P 500 right now, which is hovering around 4.85%. Step 2, you subtract that 4.39% risk-free treasury rate we were just talking about. And step 3, that gives you the implied equity risk premium. It is an astoundingly low 0.46%. Let's just slow down and really think about what that means. Investors out there are accepting less than 0.5% of extra hazard pay to take on all the risk, volatility, and pure uncertainty of the stock market. That insanely narrow gap signals extreme market optimism with absolutely zero margin for error. If inflation ticks up or corporate earnings missed by even a fraction, that tiny premium just evaporates.
For some context here, a normal, healthy risk premium historically sits somewhere between 3% and 5%. To get back to a standard 4% premium today, assuming Treasury rates stay exactly where they are, stocks would need an earnings yield of about 8.39%. That translates to a price-to-earnings ratio of roughly 12. So, by aggressively holding on to this $373 billion mountain of cash, Berkshire isn't just waiting for a minor dip in prices. They are mathematically indicating that the broader market would literally need to experience a catastrophic nearly 50% correction just for the risk-reward profile to return to historical, logical normalcy. That is wild. Let's pivot now to Section 4, Abel's Operational Alpha, mapping the shift from oracle to operator. You know, the transition happening right now isn't just about hoarding cash. It is a fundamental shift in the whole corporate narrative. The differences are really stark. The Warren Buffett era was totally defined by the oracle persona, finding incredible consumer brand moats, right? Think Coca-Cola, American Express, and holding these minority stock positions. The Greg Abel era? It replaces the oracle with the operator. The strategy is shifting heavily toward energy infrastructure and wholly owned utilities. These are known as halo assets, heavy assets, low obsolescence. In a world defined by rapid technological disruption, physical grid infrastructure is incredibly hard to make obsolete. You can't disrupt a physical regional power grid with a new app or an AI algorithm overnight. It provides guaranteed, massive utility scale. And while the rest of the market is frantically looking outward, desperately searching for the next big AI play to invest in, Abel is looking inward, relentlessly optimizing the massive machine he already controls. We can see this operational alpha playing out granularly across all their subsidiaries right now. Berkshire Hathaway Energy is executing a staggering $33.6 billion capital expenditure program just to harden the physical electrical grid for the future. Over at Geico, they've pivoted entirely to discipline. They're sacrificing top-line volume to prioritize pure profit margin recovery. At Precision Castparts, they're actively adopting robotics to boost manufacturing yields in aerospace. And honestly, most tellingly of all, when external markets are just too expensive to buy into, Abel uses that cash pile on himself, resuming share repurchases to buy over $200 million of Berkshire's own discounted stock in March 2026 alone. Finally, let's get into Section 5, the FOMO versus the fortress, where we confront the brutal macro truth. To truly understand Berkshire's posture, we have to look at the severe macro risks threatening the global economy right now. We have this profound juxtaposition of physical reality versus financial delusion. On one hand, global conflicts have driven oil above $100 a barrel, and major disruptions at the 21-mile-wide Strait of Hormuz choke point are absolutely devastating maritime logistics and spiking global insurance costs. On the other hand, the financial markets are completely ignoring all of this, experiencing rampant AI malinvestment. A perfect example? The former shoe company Allbirds suddenly pivoting its entire business model to become an AI GPU provider and seeing its stock price surge over 500% in a single day, despite having virtually zero tech infrastructure. I mean, this is pure speculative bubble behavior fueled by heavily leveraged retail investors. In an environment like this, a $373 billion cash pile acts as a necessary, unshakable ballast against both physical energy scarcity and desperate market speculation. There is a glaring, incredibly dangerous disconnect right now in market psychology. The S&P 500 is experiencing massive double-digit rallies, surging nearly 11% in a matter of days. At the exact same time, the VIX, which is the market's ultimate fear gauge, has completely crashed, plummeting over 40% down to 1797. This combination indicates a terrifying level of extreme complacency. The broader market sees no risk, no downside, and no limits, despite global logistical chaos happening all around us. It's a highly fragile short squeeze environment, and frankly, it is exactly the type of environment that Berkshire Hathaway flat out refuses to participate in. Just look at these two fundamentally opposed mindsets side by side. Retail investors are entirely gripped by the fear of missing out, driving tens of billions of dollars in speculative trading volume on gamified platforms. Crucially, they are doing this with massive negative credit balances, meaning they're actually taking out extreme leverage just to chase the high. Berkshire's stance is the precise opposite. They maintain a fortress balance sheet with extreme, unwavering conservatism. They're maintaining absolute readiness through high liquidity, while the rest of the market borrows money to buy in at the absolute top. For institutional heavyweights operating at this kind of scale, patience itself becomes an actively managed asset. And that right there leads us to the definitive thesis of the Greg Abel era so far. Cash isn't just dead liquidity anymore. In a world offering 4.4% risk-free rates while equities are drastically overvalued, the sheer discipline to just sit on your hands and do absolutely nothing until a fat pitch arrives is the most valuable asset you can hold. Cash has officially transitioned from a defensive hedge into the strategic cornerstone of a brand new asset class. So as you look at the gaping disconnect between soaring stock multiples and guaranteed treasury yields, you really have to ask yourself a hard question today. Is your portfolio designed to blindly chase momentum out of the fear of missing out? Or, like the new era of Berkshire Hathaway, are you building a fortress? Thanks so much for joining me on this explainer. Until next time.